This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Alright, in the last chapter, we looked at various points for discussion questions on mergers and acquisitions. In this chapter, though, we're going to look at the calculations involved. And it is pretty common in the exam to be asked to value place a value either on a company that we're acquiring or on our company before and after acquiring a new company, another company. And I say it is very common, but as you'll see as I go through the various different approaches we might take, depending on the situation or what the question wants, there aren't actually any new techniques involved that we haven't already covered. So in that sense, the calculations I go through should really be a revision of various earlier chapters. And as a result, I'll keep each one fairly small to explain. But in the exam, not always by any means, but it's quite often a question one or a main part of question one where there's 50 marks. And it gets, the basic technique stays the same, but it gets a lot more involved. But the problem shouldn't be the techniques. I'm going to revise them with you and tell you when and where to use each. And we've done them before. The problem is more one of approach. So please, in this lecture, I'll go through a series of little examples on each situation. But do look, if you look on the website, at the section for this exam, you'll see a section Revision Kit Live. And there I have worked through a few real past exam questions on this, where I don't just talk through the technical side of it, the calculations themselves, but also the approach. You know, how to sort out a great long question, how to make sure that you're getting pass marks on it. Anyway, having said that, off we go. Various ways you might attempt to value another company. First way, which I really don't want to spend many minutes on, for various reasons. It's, well, A, you should have seen it before in the earlier financial management exam. Secondly, it's rarely relevant in this exam. And thirdly, it's fairly common sense anyway. But what we call asset-based values. Where all we're doing is looking at the net assets of the business we're talking about and taking the value of those net assets, assets less liabilities. And there are basically three types of ways you could get the values. One, which I think you'd agree would be fairly stupid normally, would be to use book values. The values appearing in the statement of financial position. But the reason that would normally be a bit of a waste of time is you should be fully aware that non-current assets appear in the statement of financial position at cost less depreciation, which, unless they were bought very, very recently, stands to bear no relationship to the true value of the assets. Perhaps a bit more realistically, an alternative would be to look at realisable values. To again take the assets from the statement of financial position, the net assets, but certainly for the non-current assets, to value them at what they could be sold for. I don't need to write that down. And there are really two circumstances in which that might be relevant. One is for the company being acquired. Surely the minimum they'd ever normally accept would be the realisable value. Because if they could sell the assets individually and get $1 million, there's no way that they'd let themselves be sold to another company for less than $1 million. They'd be better off breaking the company up. So it's going to be the absolute minimum the target would accept and of course they'd usually expect to be paid much more. We're a going concern. Now the other sense in which it might just be relevant is you may have heard of asset strippers, companies who deliberately go around buying other companies with the whole purpose of breaking them up and selling their assets. Companies that are doing badly. Right, it's not that common because normally they wouldn't accept your offer. But you would bear in mind, you know, if I could buy a company for $500,000 and then sell the assets individually for $1 million, well, great, obviously I would. So a minimum target would accept, or as I say, asset strippers. Finally, you could consider what we call the replacement value. And here, again, take the net assets, but certainly the non-current assets, value them at what it would cost to buy them elsewhere as new. And that, subject to one big thing, really would be the maximum that the creditor, the purchaser, would pay. I say subject to one big thing, but the point is, if you can buy all the individual machines yourself for $1 million, well, you know, why not buy them yourself and set up the company? Why pay more than $1 million for this existing company? Well, the reason would be, of course, for goodwill. That buying an existing company, almost certainly, there's the goodwill. You immediately start making profits, and you expect to actually have to pay a lot more. So I said I didn't want to go on there. I mean, that really should be more common sense than anything, and it's not terribly relevant at this level. Much, much, much more important is what we call cash-based valuation methods. Where we are effectively, as you'll see, back to discounted cash flow exercises. Because before we were looking really at investing in new projects, and if you did to decide how much the project's worth, we discount the forecast cash flows. Well, in a similar way, if we're deciding how much a business is worth because we're thinking of acquiring it, sure, the obvious thing to do is forecast what the cash flows are going to be and discount them. And there are two approaches here, two cash-based, which are similar, but there's a big difference. The first method is called free cash flow to firm. And this effectively, I didn't mention it earlier actually, is effectively exactly the same as doing project appraisal. We take the net cash flows available for the providers of finance and we discount generally, but I'll come to exceptions later and explain why, we discount at the cost of capital. Discount the cash flows at the cost of capital. Now there are two ways you could be given the information here. The first way of giving it you is in exactly the same way as we're given information when we were doing project appraisal, where we actually calculate the forecast cash flows each year. And let me show what I mean with example 1. A company has prepared a forecast of the future cash flows. They're expected to be $4.5 million in 1 year's time, 8.1 million in 2 years' time, 11.7 million in 3 years' time, and thereafter, to carry on, we're buying a company. This isn't a project with a limited life. We're buying a company, and so we're expecting cash flows in the future of 11.7 million, but inflating at 4%. Now, we did something just like this when we were looking at the project appraisal. I said this was the most likely reason for it, that not having a limited life, that we're expecting cash flows forever. Now, of course, arriving at those cash flows would be all the normal work. They're unlikely to give you the figures directly, but exactly the same way as in project appraisal. Looking at the cash revenues, looking at expenses and so on, but arriving at the net cash flow. And having got the net cash flow each year, discount at the cost of capital. Here, the cost of capital is 10%, so the discount factor's at 10%. For 1 year, 0.909. For 2 years, 0.826. For 3 years, 0.751. And so for those first three, terribly easy, of course, the present values, 4.5 times 0.909 is 4.09. 8.1 times 0.826 is 6.69. 11.7 times 0.751 is 8.79. So no problem there. The problem, of course, and we have, sorry, I'll stop saying this, but we have dealt with it before, is how are we going to deal with this 11.7 in perpetuity when there's inflation at 4%. And if you remember, the way we do it is use the dividend valuation formula. The formula D0 times 1 plus G over RE minus G. But whereas when you're valuing shares, you use the dividend, here we take the cash flow, 11.7, multiply by 1 plus the inflation rate, 1.04. Instead of cost of equity, the discount rate is the cost of capital, 10%, minus the inflation rate, 0.04, which gives us 11.7 times 1.04 divided by 0.06. It gives us 202.8. Now, that would be fine if the flows were 1 to infinity. Had it been 1 to infinity, that gives us the present value now, times 0. But because the flows are 4 to infinity, they start in 4 years' time instead of 1 year's time, so 3 years later. The formula gives us a present value at time 3, 3 years later. Time 3 instead of time 0. How do we get the present value now? Well, we take the 202.8 in 3 years. We discount, to get to 0, we discount for 3 years at the cost of capital of 10%. And the 3-year factor, well, we already had it, but anyway, at 10% is 0.751. So the present value £152.1 million. So there's the present value of the 4 to infinity. And now, of course, it's easy. What was it? 152.1? And therefore, the total value, the total present value, the total value of this firm, 4.09 plus 6.69, 8.79, 152.1. is 171.67. Now, a couple of things here which are very, very important. When we look at free cash flows, I'll say there's an alternative coming later. When we look at free cash flows, it's free cash flows just as for project appraisal, and we're working out the net cash available to providers of finance. You know, that 4.5 in the first year, some of it will go to shareholders, some of it belongs to debt lenders. It's the total cash available for all providers of finance. Always these flows are before interest. There's 4.5, 8.1. That money, some of it will go to debt lenders, some of it will go to shareholders. And we've discounted the cost of capital. Well, remember, in the calculation of cost of capital, we're including the cost of debt. And so we're accounting for that in the discounting. We don't account for interest in the cash flows. But as a result, the value we end up with, of here 171.67, that is the total market value of the firm, of the business. And when I say total market value, it's the equity, the market value of the equity plus the debt. We took the total cash available for equity and debt lenders. Discount, we get the total market value, equity plus debt. And in this particular one, it tells us that we do have debt. The debt has a market value of 50 million, in which case the market value of the equity, if the total is 171.67, subtract the debt, the value of the equity is 121.67. So there we are, free cash flow to firm. Now say again, make it massively longer. You calculate, with lots more information, you calculate the net cash flow each year. But it's all the same rules, approach, workings as when we were doing project appraisal. However, there are two ways of arriving at the free cash flow to firm, depending on how you're given the information. One way, quite common in the exam, is this, where you're given all the cash flow information, revenue, costs, etc. Get the net cash flow, discount. The alternative, which sometimes occurs, is instead of giving you pure cash flow information, that you're given, effectively, a statement of profit or loss. You're given profit information. In which case, we still need the free cash flows and will discount and so on. But if we're not given all the detailed cash information, we have to approximate to the cash flow by taking the profit figure and adjusting. And see what I mean on the next page. I've given a pro forma there. Earnings before income and tax, less tax, and depreciation, so on. Now, I look back at it, but rather than talk blindly through a pro forma, let me explain exactly what I mean and how we deal with it in example 2, where instead of being given the detailed cash flows, we're told what the operating profit is, earnings before interest and tax. We're given various bits of information. And it's now our job to estimate what the cash flow is, the free cash flow for that year. And so let's have a go. We start with the earnings before interest and tax, 720. But of course, we need to convert that, if that's the right word, we need to change that into a a cash flow available for providers of finance. And so that was before tax. Well, of course, there is tax payable, so we subtract whatever tax is paid, and we're told at the bottom 336. What else? Well, remember, earnings before interest and tax are after depreciation. Depreciation's not a cash flow. Add back the depreciation. We're trying to get to a cash flow. 288. That effectively gives us an operating cash flow. That was, I'm too worried because we're not there yet. 336 plus 288. Of 672. Why isn't all that cash available for providers of finance? Various reasons. One is, look at the figures I've given you. There's a cost of new non-current assets. So we're paying out 36 for new non-current assets. Fine, there's less available. What else? Now here an assumption, but it's one I've mentioned before, and it's something your examiner always assumes. He always assumes, and usually writes it in the question, that we'll need to spend money maintaining our existing non-current assets of an amount equal to the depreciation charge. And so we need to subtract that. So for replacing existing assets, well, if we assume we need to spend the same as we're charging for depreciation, there's another 288. But appreciate that is an assumption. Check the question. If the question tells you that's the case, there's obviously no choice. If it doesn't tell you, then although the examiner tends to assume it and subtracts 288, fine, if you didn't assume it and didn't subtract 288, you would still get the marks. What else? There's interest paid, irrelevant. Because I want the net cash flow like before, cash flow available for all providers of finance. Interest is effectively accounted for in the discounting. But the one thing that, the extra bit that is going to affect the cash and is relevant is any increase in working capital. And here it's 120. So again, that takes cash. It means that the cash left available for equity and debt, or the free cash flow, uh, 672 672 minus 36 minus 288 minus 120, 228. So there's the two ways. The first way, like project appraisal, set up all the individual flows, revenue, expenses, etc., and then get the free cash flow. Or, if you're not given that information, but instead you're given statement of profit and loss items, start with the earnings before interest and tax, adjust it, and get the free cash flow. And of course, you'd either have to do that for each of several years and then discount, or maybe you will need to do it for 1 year, but you're told it's inflating at X% per year, and use the formula. So either way round, we'll discount the free cash flows at the relevant cost of capital. It's just the two different ways of getting the free cash flow. All right, well, that deals with free cash flows themselves, but I have said Well, discounted relevant cost of capital. Well, although I'm going to have a break here, again to avoid it being too long and to give you time to go back and review it if you need, in the next lecture we'll discuss exactly what cost of capital, what discount rate should we be using. But again, that's the next lecture.